Hello, the Chart Guys members. Thank you for joining us here this Sunday morning. Today we're going to be looking at the basics of options, and this is going to be designed for people that are either just beginning to explore the world of options or who are looking to do so in the near future. And it certainly is a tool belt or a tool that every trader wants to have in their tool belt because there's some big time reward to be had there. But as we know, with big time reward comes big time risk. So it is ideal for people with low capital. A lot of times we'll see people with, say, $5,000 or less dollars, they go right to penny stocks because they feel the only way they can make things worthwhile is by hitting it big on a penny stock, and we certainly know that is not a smart decision to be making. And if they focus on their education, get motivated to learn the charts, with $5,000 trading options, you absolutely can build a portfolio, can get some income, and can gain that experience along the way. So as we know, it's a very high risk and high reward market out there, the market of options, and hopefully we can get that high reward on our side by understanding some key concepts and, as always, utilizing the charts, which are the backbone of options trading. So for the introduction here, the absolute most important point, I say it time and time again, paper trade if you are new to options. I cannot stress this enough. And the analogy I always use, would you go to poker, sit down at a real money table, and decide to learn how to play poker in Vegas? You wouldn't. And if you did, you would be very silly. So why would you jump into the option market, having never traded them before, with your hard-earned real money, essentially just asking to give it away? And this comes from personal experience. I was that fool. I was 4 years into using charts. I was very comfortable with them, very comfortable with trading. I figured, okay, let's now do these options. Jumped right in, lost a few $1,000s in the first month or two, and I wish I had somebody beating me over the head telling me to paper trade first, because just because you are comfortable with charts and trading stocks, that does not mean you're going to be comfortable with options. The most important thing is watching how these options react to the price and getting comfortable with the bid and ask movement. It's going to depend on how soon the option expires with how it moves. It's going to depend on the underlying stock itself, and getting comfortable and familiar with how these stocks and their options move is absolutely essential. And they're completely different animals. If we look at the SPY options, how they trade compared to PCLN, they are very different. So getting familiar with the stocks that you are comfortable with and want to be playing certainly can benefit you in the world of trading options as well. So today we're going to be looking at what is an option, and that's going to be just a fundamental breakdown in terms of the concept of what an option is. And I'd say that's one of the biggest hurdles for entry for people when they try and learn options. It's a very interesting and somewhat difficult concept to grasp, but once you have the concept down of what an option is, it really makes everything else seem simple. And there are so many longer term strategies out there, butterfly spreads and covered calls and all different kinds of strategies, playing earnings and such, and that really can be intimidating as well. But the way that I trade, which we're going to look at, is certainly a much simpler approach where the charts are the most important thing, and getting over that barrier of understanding what an option is really can clear the way for utilizing them successfully. So then we're going to break down the option chain, all those Greeks and numbers that, again, look intimidating. Once you get the concept down, it really is easy to move forward. We're going to look at how I trade options, some personal examples. As many of you know, it is short-term trading, usually day trading, and certainly some nice gains to be had there. Entries and exits. How do you know which option to buy? When do you buy and when do you sell? And certainly the charts are very key in answering that question. And then last, we're going to look at selling options for income. It's a strategy that a lot of people use to keep that income coming into their portfolio, and we're going to look at some of those concepts as well. And then at the end, we'll open it up to questions and some discussion. And again, by no means am I the most knowledgeable person in the Chart Guys community with options. We have people that have been trading them a lot longer than I have. So anybody that wants to contribute is welcome to. I am no means calling myself an expert here, just going to pass on the information that I know and then open it up for contribution. So first off, what is an option? An option, in the most basic form, is an agreement between the buyer and the seller, and it gives the right to the buyer and the obligation to the seller to buy or sell the stocks at a later date at a certain price. So the key here is we're looking into the future and trying to anticipate what the stock is going to be, the price of the stock, in the future. And so that's where it really differs from trading stocks, because time is such a significant factor. And as we know, time decay is a big factor. We'll be looking at that a bit more when we get into the Greeks. But it's just, if you are buying a call, you are buying the right to purchase a stock at a later date at a certain price. So there's one contract is worth 100 shares, and that's only really important if you're going to be exercising these options, because otherwise you're just trading the contracts and not executing them. And I personally have never executed an option contract. I trade the premium, and the premium is the price per contract of the option. So we're trading the contract, and you can buy one contract, 10 contracts, however many you want, and that premium is the price of them. So when I am trading, I'm essentially flipping the premium. I'm buying, holding for a short-term time period, and then selling the premium, hopefully for a gain for more than I bought it for, and then moving on. So I never have to worry about executing the option. I never have to worry about buying real shares of the company. I'm just flipping premiums. The strike is the price that the shares can be bought for call options or sold for put options, and we'll look at the different strikes and what they mean on the option chain when we get there. So when you're buying and selling options, we're going to look at the most basic, fundamental way to buy calls or buy puts. So there are four things when you pull up an options order. You're going to see buy to open, sell to close, sell to open, and buy to close. And we're going to be looking at buy to open, so calls and puts. If I want to buy a call, I am buying to open. If I want to buy a put, I am buying that put to open, and then I sell to close. So if I think the stock's going to be in a bullish uptrend, I'm buying calls, and if I think the stock is going to be going down, I'm buying puts. And the most simple fundamental breakdown here is that you're paying a premium. So that's what the premium that you're trading. I'm paying for the right to purchase these shares at the strike price in the future. There is unlimited reward, meaning I can make 100%, 500%, all depends on the stock's movement. And there's limited risk. I'm not going to lose any more than I put in. Worst case scenario, I lose everything that I put in. But again, you can't lose more than you put in, which is a bit of protection. So you buy to open and sell to close, as I said. This is possible in a cash account. And to buy calls and to buy puts, you can do that in a cash account, which means there's low capital required. And there's a couple things that doing this allows you. Pattern day trading does not apply to cash accounts trading options. So that's one benefit. And the other is that options settle the next day. Stocks take 3 days to settle. So if I'm trading in a cash account and I have $5,000 and I am trading, let's say $1,000 per options position, I can make 5 trades in one day. That's as many as I can make in one day, because then all my cash is used up. But the next day, I have that $5,000 available for trading again. I don't have to wait those 3 days. So there's ways that you can, with a small account, depending on the size of the positions you're taking, you can have it so that you're always able to buy and sell these options, and you're never going to run out of that day trading capital required. So I could have, again, an example, $5,000, and let's say I make 3 trades that day, and then I have $2,000 still left to play with, but I don't see anything else that I want to play with. Next day, I've got a $5,000 position again, or cash position that I can play with. So it really opens the door in terms of small portfolios being able to play the big boards, and the big boards meaning big stocks. Like if you have $5,000, you're certainly not going to be anticipating making any kind of money, any kind of significant money, day trading Apple common shares. It's just not enough money to make a dent. And that 5,000%, if you're lucky, you'll get 1% a day. And that certainly is going to take a long time to add up. But with options, that buying power is greatly increased, and those percentage gains can be as well. So now we're going to look at the option chain, and first we'll break down some of the definitions of what is on that option chain, and then we'll look at a real live example of the option chain. So first we've got the volume. That's pretty straightforward. It's the contracts traded in the current day. The open interest is the volume of outstanding contracts that have yet to be exercised. So that's essentially positions that people are still holding. They bought perhaps 2 days ago, however many days ago, and they have yet to close those positions out. So then we're getting into the Greeks. The delta is the movement to the upside or downside of the option price relative to a $1 move in stock. So we'll go over an example here tying these all together. And next we have gamma, which measures the rate of change in delta. Theta, which is time decay. It's the drop in price of option per day. And then vega, which measures the change in volatility. And as we know, when stocks get close to their earnings, volatility is anticipated to increase. And so you see people say a lot of times that the options are really expensive when we get towards those earnings because a big move is anticipated and the price of those options goes up to reflect that. So that right there is where most people get lost in terms of new people looking to explore options, and these Greeks just trying to wrap your head around what's going on there is really complicated. And when we look at my style here in a little bit, I really don't pay too much attention to those Greeks because of how short-term my trades are. They really don't play a significant factor. So let's look at an example. The delta, let's say the delta is 0.4 of the option I'm looking at. So that means, let's say it's Apple. Apple is at $100 and the delta is 0.4. So if the stock goes up to 101, that means the value of the option is going to go up 40 cents. If the stock goes down to 99, the value of the option is going to drop by 40 cents. The gamma, let's say that was 0.1, that means if Apple goes up to 101, the delta is now going to go up to 0.5. And vice versa, if it goes down to $99, the delta is going to go down to 0.3. So that just gives you, the gamma is completely related to delta. And again, the delta tells you how much you can expect the option to go up or down based on the movement of the underlying stock. And last we have theta, that time decay. Let's say it's 0.808. That means the option price is going to lose 8 cents per day. And that means if all else were equal, let's say the stock price stayed the exact same all day. Obviously, that's not going to happen. But the option value would drop by 8 cents just due to that time decay alone. So these Greeks are a lot more important, in my opinion, for the longer term you're looking to be in a trade. Let's say you're trying to stay in for 2 weeks or even 2 months. Then you're going to be paying attention a lot more to what these Greeks are and how they change on that option. So now we're going to be looking at the option chain. And again, if this is all new to you, it's very intimidating. This is the biggest hurdle to get over. It's all Greek to you at this point, pun intended. And once you get it hammered down and get more comfortable with what these numbers mean, it really opens up the world of option trading to you. So this is a SPY option chain. And what I want to get right out of the way first off is that a lot of stocks only have Friday expirations, meaning that every expiration date is going to be a Friday, this Friday, next Friday, so on and so forth. But for SPY and the S&P 500, they are so heavily traded that there are multiple expirations. So a weekly option doesn't just mean Friday, because here on SPY, we've got one expiring. These are all expiring this Wednesday. Then we've got this Friday, next Wednesday, next Friday. You get the idea. So weekly here, we have multiple expirations in this coming week. So we've got calls on the left side, puts on the right side. The information is the same for both of them. And right down the middle is the strike, and that's the price of SPY that we're going to be looking at. So let's go down the list here and to explain them a little bit more. Last is the last price traded for that option. Change is the percentage change compared to yesterday. The bid and the ask, that's straightforward. You want to make sure that bid and the ask are tight. If you have a wide bid and ask spread, it can be difficult to get a good price of those options. And you don't want to be buying at the ask if there's a wide bid and an ask, because if, say, the trade does not go in your direction early on and you want to get out, you're going to take a big loss by trying to sell at the bid because you bought so high at the ask. So SPY and the S&P 500 have really nice tight bid and ask ranges due to how much trading is going on. So that's very beneficial, and I would suggest trading, or at least practicing paper trading on SPY or a very liquid, Apple's very liquid, Facebook, all these big names that have lots of activity. Practice on those first, as there's a really nice bid and ask spread. Volume is how many contracts are traded in the current day. Open interest is how many contracts are still open and have not been exercised. Now we're into the Greeks. So again, delta is the increase or decrease in price of the option in response to a 1-point move in the stock. So here let's look at 220 calls on SPY. So the delta on the 220 calls is 0.1159. So that means if SPY were to go up, we're currently at 218.37. If tomorrow SPY goes up to 219.37, that means I can anticipate the price of the option to increase by 11.59 cents. Next we have theta, which is time decay. And again, that is the drop in the option price each day if all else remained equal. So let's say SPY in 1 day from now, if we were trading, is 218.37, price remains the same. That 220 option is going to drop by 2 cents, 254 cents. So we can anticipate all else being equal. That's the time decay that the option is going to see. Next, we've got gamma. Gamma measures the rate of change of delta. So let's say that 220, let's say SPY goes up by $1, and now we have the delta reading at 0.1559. We know that the gamma is 0.04 because the delta has increased by 0.04 for the price moving up by $1. And again, if all of this isn't making sense the first time around, by no means get discouraged. I would dive in and do further research outside of this webinar here and look at them one at a time. There's a lot of information out there. You can read up on delta, focus on delta for a few days, just delta, reading up, then move on to theta, so on and so forth. Last here we've got vega, and again, that it measures the change of volatility, and the more volatile, the more expensive it's going to be. When earnings come up, that volatility spikes, so the options are more expensive. So, and again, on the right side for puts, it's the exact same thing. Last, change, bid, ask, and then the deltas, or the Greeks over here. And that is the breakdown of what we're looking at. So again, tackle it one at a time, get more familiar with what they mean, and then watch how they react during the live trading day with the movement in price. And we'll go over my personal style because I want to emphasize again here that you don't need to be all caught up in these Greeks. If you're trading longer term, if you're trading multiple weeks and multiple month options, then absolutely these Greeks are important and you need to be watching them, and they should be influencing which strike you're buying, which expiration date, so on and so forth. But if looking to just get a grip on options and look for short-term trades, you don't need to get all caught up in these Greeks and watching what they do every tick compared to SPY's movement. So this is an option chain, and again, you can make it simplified. Let's say I'm not looking at anything more than stuff that's coming up. I can choose which expiration dates I'm looking at. I can choose which Greeks I want to look at, simplify things down, or expand them out and get more information. So now we're going to move on to my personal style of trading and some specific examples. So looking at my style, and I clearly have tons of it, but my style of trading options is short-term, mostly day trading, quick flips. I'm holding the option for anywhere between 10 and 60 minutes, I would say, most often. And because of that short of a time frame, I'm not concerned with time decay. I'm not concerned with what's going to occur from one day to the next because I'm not going to be holding for that long. So the Greeks are much less important. And the strikes that I'm going to be playing, when I'm looking at which option to be buying, the most important factor to me is whether the strike is in the money or out of the money. And these days, most of the strikes that I'm playing are either 1 or 2 in the money, and that's going to dictate which one I play rather than looking at all the Greeks and deciding which one I want to play. And because of the short-term, fast nature of these options, I don't even have time to factor in what those Greeks are and to do out any calculations with that regard. So I'm looking for liquidity and tight bid and ask to be day trading, and it's really good with SPY, so that's one of my favorites to trade, and it's also, again, good with Apple, Facebook. I do like trading PCLN a lot, but the bid and the ask is not nearly as tight, and that's because PCLN is a $1,400 stock, so the movement in those options is significant. I would say PCLN options have a higher risk and a higher reward than the SPY options do, just in the fact that if you do get a nice move to the upside, those options are going to move very quickly and see some big time gains. But that also, it means that with PCLN, because it is a $1,400 stock, you're going to have to put up a little bit more capital in most of these options. one contract is going to cost you anywhere from $1,000 to $5,000, depending on how far in the money or out of the money you are looking. But these are two of my two favorites, SPY and PCLN, and both of them are very different. And we do have members in the chat room who trade specifically options on PCLN. That is their bread and butter. They watch it daily. They're very comfortable with how the bid and the ask of the options move relative to the price of PCLN. And they are, I'm sure, are a wealth of knowledge for that specific stock and those specific options. So again, I want to highlight, I am not an options expert. I'm more comfortable in penny stocks and teaching penny stocks than I would be here with options. And that just relates to how often or how long I have been trading them for. So now we're going to go into a specific example of an option trade that I made just this past week. And it was SPY September 1st, 218 puts. And of course, it was based on the price action on the 5-minute chart of SPY that told me I wanted to get into these puts, and we'll look at the risk to reward and how that trade played out. So here is SPY on September 2nd. We're going to look at the 5-minute chart, which is initially the setup that I was looking at that had me wanting to play an option. And it was because we had a very bullish move to the upside. We rejected, hitting a lower high continually on the day, rejecting from these moving average resistances, pulling back, rejecting again, still holding on, rejecting, rejecting, rejecting. So I started looking at this put about right here at 1:35 p.m. And this is when the range was tightening between exponential moving average support and key 100 and 200 period moving average resistance. So I saw that that level was getting very tight, and I essentially played it as a top fishing play. And I would have exited my puts if we saw a break of this 217.38, because that would mean we consolidated and then set a higher high to the upside, continuing bullish strength. So I use it as a bit of a top fishing play, and I can look at the option and see what was the price of the option when SPY was at 217.38. What's the highest, or for a put, what's the lowest price that that put hit? And then I can place my stop loss a little bit below that level, and I want to give some wiggle room for a little bit of time decay if we do trade sideways for a while, and also just a little bit of time decay for overall cushion. And that's a good way to gauge where to put your stop loss level by looking at the previous price history just a half an hour ago where that option was at. So in terms of which option I wanted to enter, let's say the price here is at 217.31, so I know 217.50 puts are 1 in the money. I know 218 puts are 2 in the money because the price is below them and I'm looking for a drop. And determining which I play, either 1 in the money or 2 in the money, will depend on the amount of contracts I would need to purchase. So say I want a $1,500 position here on these puts, and if I'm trading 1 in the money, let's say those puts were 50 cents and I would have to buy 30 of them to see my $1,500 position. The more contracts you buy, the larger your commission fees are going to be. They're based on a per contract basis. So if there are times where my commission fee for a trade would be $50 or something like that, I'll go one further out of the money, or one further in the money, I should say. And that means that the price of the option is going to be higher. So I will be able to purchase less contracts for that $1,500 of capital that I am trying to play with. So here I entered 218 puts, and pulling up my trade review on my other screen here, I entered them at 119. So this is actually on September 1st. I said September 2nd, but September 1st, entered the puts at 119, right about here at 9:35 p.m. And another reason that I was comfortable with this position, because the bulls clearly had showed up and showed a lot of strength. So I am playing against the trend, but what I was looking at was the hourly chart here, and this candlestick had just closed, rejecting from the 20-period moving average resistance. So I knew that we were going to see another test of this resistance level, which was at 217.28, and I was anticipating after this short-term bounce that we would reject from this level and see a pullback. So the hourly chart resistance added confidence for me at that 217, low 217 resistance, which lined up with these 100 and 200 period 5-minute moving average resistances. So I was in the option, in my position, put my stop loss just below where the price had hit on this 217.38 move, and then I waited patiently. the range got tighter and tighter and tighter, and then we saw a 10-minute dump move to the downside. And in this 10 minutes, I believe I sold on this actually the third candlestick here. Once that low, 216.83, and then 216.81 held. So I saw that some support was being established in the 216.80s, and I liked those gains. Those options moved from 119 when I purchased them, and then after holding for about 20 minutes, and then the break occurred. So essentially 30 minutes total in the trade. I sold those options for 143. So 119 to 143. Let's do simple math. Let's say I was in 10 contracts at 119. The position would have cost me $1,190, excluding commission, just to be simple here. And if I sold at 143, I then got $1,430. So that was essentially a $240 profit on a $1,190 position. So essentially over a 20% gain, 30 minutes holding that option and just flipping the premiums. The premiums went up and I locked in that profit and got out. I have no obligation to purchase any shares. I don't have to worry about expiration day, none of that. I'm in and out quickly. Thanks for the profit. On to the next trade. So that was a real life example. And again, 30 minutes, over 20% gains. That shows you the power of the options. 240 profit to be made on $1,200 position. So you can imagine if I was playing with $12,000, I just made $2,400 in a half an hour. So big time risk and big time reward. Had I been stopped out, let's say the bulls did hit higher highs, I probably would have lost the same amount of money. I would have lost a little over $200, which is a significant blow to a $1,200 position. So it's important to keep those stop losses tight, and you can use stop losses on these SPY options because the bid and the ask are so tight. And there are some instances where stop losses can be a negative, and we'll look at those here in a bit further out in the next little slide here. And that's when the bid and the ask is wide. Using a stop loss can really hurt you. And I certainly would suggest caution using stop losses on options that have wide bid and ask spreads. And essentially to skip all of that concern, just play options that are tight with high volume with a close bid and ask. So moving on now. So now we're going to look at entries and exits and understanding or trying to grasp which option to play. And we've touched on that a bit so far. And bid in the ask range is a very key component. That's one of the first things you're looking at. Volume and liquidity is huge as well. And if you're starting out with trading options, I would absolutely suggest paper trading SPY, Apple, and those big names that have high liquidity, tight bid and ask, and those stop losses are much easier on that tight bid and ask than they are on illiquid options. I would not suggest playing illiquid options. It really is a whole different animal and a lot more difficult. So we've already discussed that I like playing one or two in the money. If you're going for a home run, if you're wanting to be really risky, a lot of people say lotto plays, which means they're assuming they're going to lose that money, but if they hit it, they're going to hit it big. And that's going further out of the money. So let's say Apple's trading at $100 and it's Thursday, and I'm playing weekly options that expire in one day. And if I wanted to buy a lotto play, I would essentially be buying a $102 call, which means the price needs to see a 2% move in one day in order for me to be in the money. And again, time decay is going to absolutely destroy that option over the next 24 hours. But if the bulls somehow did see a run, or if news came out and we did see a move to that upside, then there's going to be some big time gains to be had in that option. So depending on how far in or out of the money you're going is really all about risk and reward. And I think the best position to be in is one or two in the money. It's a personal preference. And lotto plays on earnings, people really do that just for fun, and it is absolutely gambling with a high payoff but high risk. So the stop losses, again, much trickier than with stocks. Although that example that I just gave with SPY, because we have such tight bid and asks, much more clear on where to put your stop loss level. That was a top fishing play, and we knew to exit if higher highs were hit. So when you have the wide bid and ask spread, let's say the option, the bid is $8 and the ask is $9, and I'm in with 10 contracts. So that's essentially a $100 difference, $800 if I were to sell at the bid, $900 if I were to sell at the ask. That's an 11% difference or more, and that's very significant. So the wide bid and ask can stop you out and make you lose a lot of money real quick. And there are often times where once the top bid gets knocked out or moves, it's a big drop down to the next bid. And if that were to stop you out, you would lose a significant percentage. So there are times, I know I preach, have a stop loss on every single trade. There are times where if I know I'm going to be sitting on my computer and I have my sell order filled out and it's just waiting for me to press a button, there are times where I will not have a stop loss order in and placed because I am right there, finger on the trigger, watching the action, and I don't want a wide bid and ask spread to knock me out of a stop loss and give me a significant loss before the stock move goes the way I'm looking for. So another key, very critical component, and this is a personal suggestion again, you want to sell while the stock is moving in your direction. And essentially, that is going to make it a lot easier to exit. You want to sell on the ask when the stock's going in your direction. So if I'm in calls, I want to sell while the stock is moving up and on the ask. And there's the potential that I leave some money on the table. Let's say it goes up a little bit more over the next 5-10 minutes, but I would absolutely give that up in terms of having the alternative happen, which means the move goes up and I'm in getting my profit, and then the top is hit and we start to pull back, and then I'm trying to sell by filling the bid or selling at the bid because people aren't buying at the ask anymore because the stock is now heading down. And that is a really good way to give back profits. Chasing the option on to the downside and trying to sell at the bid is really not a good way to be playing. So I would absolutely suggest to sell while the stock is moving in your direction, and having your entries and exit targets. Those are just the moving averages, and it's the basic concept that we use when trading stocks. And if you want some more information on that, we already have an educational video on when to enter and when to exit, when to take profit, where to place stop losses. All that information absolutely applies to options. And so if I were looking, I was in a call and I was looking at a nice move to the upside, I would be looking to sell before a key moving average resistance or a key previous price resistance level, same as I would on a stock. So one thing we know that these options are really good for is unusual options activity. So we certainly know that these options are a great way to make a whole lot of money really quickly. And we also know that the stock market is absolutely manipulated, it's not fair, and there's people with inside information trading. So if you have inside information or something in the know that the public is not aware of, you are going to be looking to capitalize that in the options market. Because let's say, we'll look at a Twitter example down here, but let's say Twitter is at $19 and you know good news is coming out, which is what happened this week, and you're looking at a $1 move to the upside, so a 5% move. If I'm looking to play $100,000 worth, that 5% move, I'm going to make $5,000. If I were to put that $100,000 in a weekly call, I'm going to make 30% easy, way more significant gains. So if you have inside information, you're going to be trading if you had inside information, you better be sharing with the group. Just kidding. But if someone's going to have inside information, they're going to be playing options to capitalize on it in a big way. So that is why these unusual option activities, these alerts are really good information to have. And we just made a new channel in the chat room, and that is called Options Activity, and that's where we're going to post those unusual option trades that stand out. So one name here, Wall Street Jesus. I've been hearing this name for years, and it's because he does a good job. It's an expensive service, $225 a month, but he highlights these unusual options activities. And you know, if you watch CNBC, the Nigerian brothers, they do that as well. That's a big part of their trading strategy. Watching where the money's coming in. It's a follow the money strategy, and it definitely has paid off time and time again. And here's an example. We have plenty of great members. I could highlight all kinds of members that contribute to the unusual options activity information that we get in the chat room. But here's just an example in this past week. Member BKTB, want to give him a shout out because he was posting on Wednesday, Twitter big call buying September 18.5 weeklies. So that means someone is placing a big bet on the next 3 days of trading that the stock price is going to be significantly above $18.50 in the next 3 days. And if we look at the Twitter chart, which I will flash here in a moment, we're going to be looking at a big time move to the upside. So let's look at that real quick here now. So here is the Twitter chart, and the alert by BK was given in the chat room here on August 29th. And at that point in time, the big options activity was in the $18.50 strike. And for the vast majority of the day, that strike was one out of the money. So someone made a big bet that over the next 4 days, we were going to see the price get above $18.50 and see a move to the upside. And that's obviously exactly what happened. And news came out. So someone knew of this news coming. And at the time of the alert, those options were at about 28 cents or something below 30 cents, which means that if the price were to go to $18.80, that is where those calls would be executed to essentially be worth what that buyer was paying. So by the time we were up here at the top of Thursday and the price was above $20, those options were over 700%. So that tells you someone in the know making a big bet. Had they placed that same amount of money on common shares for Twitter, they would have made some nice gains. They would have made maybe 7%, but that does not compare to 700%, and that shows you the power of options, the power of following the money and seeing where the money trades. So now we're going to look at a different example here on a strategy of earning some consistent income with trading these options, and it has to do with selling options, and most specifically selling puts. So selling options for consistent income, there's strategies out here in the market for earning consistent income, and we know that shorting UVXY and TVIX and those volatility names has been a great way to earn consistent income over the past couple years and pretty much since its inception. But here's another one, selling options. The vast majority of options expire worthless, so that is a point in favor of selling those options, because those option sellers earn the premium and walk away because the vast majority expire worthless. So when you're selling puts, you choose sell to open, and you're essentially paid that premium right away. It goes right into your account, which is very enticing, but obviously there are scenarios where it doesn't go in your favor, and that's why it's important to be selling puts only for companies that you want to own. That doesn't mean you have to have the intention to owning them, but it's going to be a scenario where worst case, let's say you sell a put and the price expires below the strike price. That means you have to buy the shares. So you want to be doing it for a company that you wouldn't mind. Worst case scenario, you're going to have to buy the shares, and that is because you will have to own that position. So if the stock stays above the strike, let's do an example. Let's say I am trading Apple $100 and I sell $100 puts, but I don't mind owning Apple because it is a powerhouse and I think the next iPhone is going to be the great big thing. So I sell puts at $100, and if the stock stays above $100, by the time my option that I sold expires, I keep the premium that I got right out of the bat and I walk away. That's the end of the trade. If the stock falls below $100, I still keep that premium, but I'm forced to buy 100 shares per contract of Apple stock. So worst case scenario, you're going to be forced to buy shares of the company, and it's not necessarily a bad thing. Of course, if it is in a downtrend and the stock keeps continuing to the downside, then you're going to be in a position that is underwater. But it's important to factor in here trading margin versus cash when you're selling puts. Because say you're trading margin and you only need, let's say, 20% of the position in cash. So let's say I bet $100,000. It's a big bet, but selling puts for Apple, $100,000, but I only have $20,000 in my account, and then the price goes below that $100 strike, and I'm forced to buy that full lot of Apple shares. I'm not going to have enough money in my account to do that, and the brokerage is going to liquidate my other positions to make me able to do that. It's not going to be a good scenario. So you want to ideally have the cash in your account to cover the worst case scenario, which would be you being forced to buy shares of the company. And again, it's not a company you hate, so it's worst case scenario, you're owning shares of a company that you don't mind owning shares of because you are bullish in the mid to long term of that company. But you want to be sure that you have the cash in your account to cover that, because it obviously would put you in a hairy situation if you don't have that cash. So I've never used this strategy, admittedly, and we do have members that have used it. And again, certainly lots of members with lots of experience, and hopefully some of them among us here would love to help answer some questions. That's the best part about this community, is the willingness for people to contribute and share information with each other. So we're going to open it up now to some questions. And again, anyone is welcome to chip in with their responses. And the more that we all know and the more eyes that we have on the market, especially in terms of unusual activity, if we have a lot of people scanning for these unusual options activity and alerting the chat room when they occur, it really is a win-win situation for everybody. So I appreciate you being here this Sunday morning. Let's now open it up for some questions, and let's get going.